I'm Mark Starosiak, Managing Partner with Infinium Investment Advisors. This is our market update for the week of May 31st, 2012. As a reminder, anything we talk about is purely for informational purposes. It's not designed to be a recommendation to buy or sell securities or follow any particular strategy. We do not provide tax and legal advice, and always consult your own financial advisor before making any investment decisions. With that, some very important topics to cover today. You know, stock market's getting creamed, right? Well, today, yes, it's actually June 1st today. Markets are taking it on the chin, but we have to keep that in perspective as well. You know, the crowd seeks the next bubble. They will always seek it out and try to find it, and we believe that they've done that at this point. And then finally, you know, how do you sleep better at night given everything that's going on in the markets? And we're going to tie that back into planning, which is a big theme for us here at Infinium. So historically, when we look at the markets, in this slide, we can see that after a 40% drop in the markets, they tend to follow a similar pattern. No guarantees, of course. This may not hold true, but up to this, these three blocks here have been fairly consistent with this downturn that we've seen from the financial crisis. And where does that put us in this last block right here? In a trading range that is very wide, 52% wide. And that can last, 5.5 years or so. We're getting to about the halfway point of that if the trend follows previous patterns. So what's the bottom line here is if we stay in this range, you know, you have to be a contrarian in our view. You have to be willing to step in and do the opposite of what the average investor is out there doing, because we know the average person, average money manager gets it wrong. And if you want to profit, if you want to get to those financial goals that you have, you've got to be willing to be different. And being different means, you know, potentially buying into periods of weakness, selling into periods of strength. Okay, that's just good portfolio management. So where's that next bubble, right? Well, clearly one can make an argument for bonds. You know, this chart just shows you the flow of funds. So where are people putting their money, whether it's stocks or bonds? And, you know, it's very easy to see back in the 90s what was happening. Everyone was all giddy, you know, and in the late 90s, the NASDAQ was up 50, 80%. The whole tech bubble, we're all familiar with that. But indeed, what should we have been doing differently at that time? Should have been throwing those stocks away and buying bonds. That was a terrific time to be buying bonds when nobody wanted them. And then we had a slight recovery here in the 2000s. Now, this blue bar represents all the flows into bond funds, right? Nobody wants stocks anymore. Stocks are despised. They're too risky. They haven't done anything for me for 10 years and on and on. But when you see these extreme moves in the market, that can be a cue to do just the opposite. So we're not saying that this can't last, this trend into the bond market, but it's worth noting and it's worth paying attention to, because at an extreme like this, more than likely, or many times often, it makes sense to do just the opposite. So we would make an argument that although stocks could be rather risky going forward, given we're stuck in this trading range, the risk-reward relationship is actually very favorable for stocks here. Doesn't feel that way, and the naysayers will argue against that. Well, mark this, mark that, Europe, you know, all the news, right? All the bad news. Well, the news changes. It's different every time. It's an oil embargo. It's a president being assassinated. It's world wars. Whatever you want to call it, fill in the blanks there. The one constant through the years is the human element. It's human beings and how we react. And again, our argument is the masses will find the next bubble. And when they do, you want to start to shade away from that. So this is a very telling chart in our opinion. So notwithstanding today is a tough day in the markets, you know, the trend is still up here. We are certainly still in an uptrend. This is a 5-year view of the S&P 500. This chart, in my opinion, although it's not a straight up line, which isn't sustainable, this one could argue is still intact. Now let's compare and contrast that to gold. You know, gold had this massive spike back in August of last year, represented here, and it's clearly in a downtrend. It's breaking down lower lows. Again, today there's a flight to safety or a flight to gold. Remains to be seen whether or not that sticks. But this is clearly a chart that would tell you the trend is going to remain down. And until we see some type of major reversal in gold, it remains a place to stay away from. So all the commercials you see on TV, all the strip malls, we buy gold, and how everyone's so hyped up about it, it is a place that we consider very dangerous. And this, although not necessarily in a bubble fashion like the bond market, for example, it is clearly had its day in the sun. And we again would caution you as investors to not get caught up in this hype, in the fear factor, because the market here in precious metals at least is telling us something different. It's telling us the trend in price is probably to the downside. So our considerations for you are, as of today, which is actually June 1st, the markets are taking on the chin, but for the year, we're about even. Okay? It stinks to give back all those gains that we made through the first part of the year, but let's step back and take a look at this. This is not a wipeout. This is not a disastrous year. It is a volatile year, but not necessarily one that's really damaged you unless you've made some bad moves. So we want to keep that in perspective. And this ties down into number 3, gets into the planning piece. And we stress this a lot here at Infinium. What does your money need to do for you and when? It's important to know this because the people, the investors who have done their due diligence and have sat down with their advisor and done their planning are much more confident when we have days like this, because a good plan will anticipate these rises and falls that we see in the market. And then, of course, skipping back up to number 2 there, stocks are despised right now. It's completely opposite of where we were at the tech bubble in 2000 when people wanted stocks and then they wanted more stocks. So, you have to look at that and ask yourself, way back when, what was the right thing to be doing? It was actually getting out of stocks. So, we think the markets and investor psychology has literally come full circle. And to us, that would indicate that the risk-reward relationship is actually pretty good here for stocks. With that, I am Mark Starosiak. Hang in there, and we will see you next week.